All right, next we're going to jump in on our market view. We think it's really important to continue to revisit this with investors because we want to invest in a thesis that has long-term merit. And we really see a lot of things that we like in the long-term fundamentals of multifamily. Some of this, if you've heard us talk or if you've read our updates, it's probably going to sound like a broken record, but we think it's really, really important to understand. And the conversation is really going to center around two concepts. One is the operating component of the business right now, the supply and demand of the actual real estate market, but then also the capital markets, right? The supply of debt and equity and how that impacts the opportunities that we're seeing today. So jumping in, the headline of what's gone on recently is there have been historic levels of new supply for really the last 2.5 years. This is entirely a function of very low interest rates in 2020 through 2022. Everyone was able to make sense of doing development deals. And at the time, debt was cheap. And that was really what fueled a lot of developers getting things done. And equity was cheap at the time. So we saw crazy inflation in 2021. And then suddenly thereafter, in 2022, 3, and 4, we saw a dramatic increase in new supply, particularly in the Sun Belt regions. And you can see the way that played out here. And this is a graph that shows occupancy and rent growth. This is a testament to the demand side relative to the supply. To supply. So you can see in 2021, rent growth spiked, vacancy was way down, and then over time that flipped as all these new apartments hit the market. Rent growth went down, and occupancies went down as well, or vacancy went up. Now we're finally starting to see ourselves get on the other side of this huge influx of new supply, and rent growth is moderating more to its historic level of 3%, and vacancy is settling back down towards 5%. So in a lot of ways, we're viewing the world as sort of returning to normal, but what we saw in 21 and 22 wasn't normal, and what we saw in 23 and 24 wasn't normal. That said, the demand drivers for multifamily have been incredibly powerful and continue to be, and we don't see that changing as we look forward. There are about 130 million households in the United States. We have averaged about 1.3% household formation over the last 10 years, and that's continued even in the recent years. So just playing that out, 130 million households, we need about 1.7 million new households per year in order to just keep up with demand. And the reason that household formation continues to grow, it's all listed on the left side of the screen here. There's an aging population, people are getting married later, there's unaffordability in single family homes, and the combination of that with student loans being more burdensome, people have to stay, they're still renting and they're not moving into single family homes as much. And then you just have the kind of machine of population growth that we see in general. All of that's giving way to the 1.7 million households of new household formation per year. Generally speaking, about 2/3 of that has been single family homes, about a third has been apartments. I think that's shifting more towards apartments as single family homes become more unaffordable. But that means you got to produce 500,000 to 600,000 new apartment units per year just to keep up with the demand. And so the demand side of the equation is incredibly strong, and we expect that to continue. On the supply side, we kind of talked about this already. You can see there was a long period of time following 08, 09 where the new supply was very low relative to historic averages. And just recently, we've finally seen that peak above the long-term historic average. That line across the middle is the historical average since the year 2000. Now, the reason that we felt some pain is because it was so much, so fast, and it was very concentrated in high growth markets, particularly across the Sun Belt, where they saw historic levels of new supply. And in those particular markets, it was hard for demand to fully keep up. And that's where you see some pain in occupancy, some pain in rent growth overall. But here is where we think the story really starts to turn into today being an exciting buying opportunity. As a fundamental principle of investing, we believe you should invest through all cycles. But we think there's some unique tailwinds that are going to be behind us in the next couple years. And this slide really starts to get at that. You can see in recent years, we have seen massive numbers of new construction starts. And that's what's shown here on the screen. You can see these years of historic levels of new supply. But as interest rates have gone up, as the availability of capital has gone down, and as costs have gone up, construction costs are significantly elevated and continue to trend that way. Talk about tariffs only throws gas on that fire that things might get more expensive really quickly here. We are seeing new unit starts dramatically down. And that's going to mean in 2 years from now, when the projects that are starting today would be delivering, there is going to be significantly less supply in the market. And we think there is an incredible opportunity because of that. We can buy today in a period of little bit excess supply. You're buying at higher cap rates on actually lower operating incomes because you have a little bit more vacancy, a little bit more concessions. And over time, we expect that to stabilize. And we think deals that we buy in today's environment are going to be really attractive. A couple other things on just the supply and demand equation factors that impact it. Home prices are up 135% since 2012, and rents are only up 81% over the same period. It is becoming harder and harder to buy a single family home, and that's not going to change. The cost to build new homes is so astronomically high at this point that you can only really build new supply to cater to the very top echelon of home buyers that are in the market today. Another way to look at that same data point, cost of home ownership is 64% higher than the cost to rent, and that gap has really widened in the past few years as home ownership has gotten so much more expensive, in large part due to high interest rates. We're seeing that gap is as wide as it's been in a long time, and we think that's going to push, if those 1.7 million households that we talked about earlier, we think that's going to push a greater percentage of those into renting, which bodes well for multifamily. This is a really important slide. We talk about this a lot internally. We think it's important to take a longer term view of rent growth and of the cost of construction. And if you look at both of those metrics since the year 2000, over that time, construction growth has averaged about 3.7%, while rent growth has been about 3.2%. This is speaking nationally, kind of from a 30,000 foot view, but theoretically, rents should at least keep pace with the cost of construction, right? In order to justify building new apartments, you have to believe that you're going to get higher rents in the future than you can get today. Right now, as rents are trending down in so many markets, it is almost impossible to pencil new construction deals unless there's some sort of dramatic extenuating circumstances that reduce your costs, like tax abatements or TIF or something like that. But what we're seeing is that construction has grown at 3.7%. We actually think that there's more room for rents to catch up because, in theory, rents should always at least keep pace with the cost of construction. A couple other things to note, the gaps between asset classes are as wide as they've been. We think there's a lot of opportunity for value add strategies. And what does that look like for us today is we think there's an opportunity to buy nicer, newer, call it early 2000s, even to like 2015 vintage product, where it is dramatically less expensive to rent those units than it would be the brand new stuff that's being delivered. And we can employ a lighter value add strategy to close the gap between the brand new and the pretty new. And at post renovated 2008, 2010 vintage property, looks and feels not that different than the brand new stuff, but it's still a meaningful gap that we can capture some of. So you can see the way that gap closes here. One other thing that we've noticed in the Class C renter type demographic, that renter got hurt very badly by inflation. In theory, these are renters with just a little bit less cushion in their financial picture. Rent went up very quickly, as did everything else in life. And that asset class has really started to feel some pain as those renters just can't afford to pay for their life in this new world that we're in. So we're generally staying away from the Class C apartments and really more focused on that B to A conversion or a little bit nicer, newer properties in great locations. Last thing to say here, rents have grown more than the median household income, especially in certain areas. And so you have to be very careful about where you're investing. You have to be aware of legislative risk if there's any rent control that's been proposed by municipalities. And then you also have to know that you're investing in the right locations within a market. It's very different investing in the best market or best submarket with the best school versus areas that are a little bit more workforce in nature. We're very sensitive to that. In fact, we go through and we buy a property and we read every single lease and we verify the income on each of those leases. And we want to see that the year 3 projected income that we're projecting after we execute our business plan still is covered by the tenants actually at that property by about 4x or greater. So that's an important part of the due diligence that we're doing, but it is something to be aware of as you look at multifamily. So that's all playing into supply and demand as it relates to the multifamily apartments themselves. But one thing that we think is just really important to consider is the supply and demand in the capital markets. Equity availability, the amount of investor demand, has a tremendous impact on valuations and cap rates. What we have seen is that equity flows into real estate are down dramatically from their peak in 2021 and 2022. There's a couple reasons for that. You've got a few different equity sources. There's the syndicators, the ones that pop up, when things are good, that threw together some deals with ultra high leverage and now have largely felt some pain in recent years. They're not doing deals as much as they were. But more meaningfully, we're seeing the large asset allocators allocate meaningfully less to real estate than they were a few years ago. Their bond portfolio got crushed when rates ran in 2022, and they had to reallocate to maintain their allocation away from real estate to their bond portfolio. And here's how that's played out. This shows it well. In 2021, the large private REITs allocated just over $34 billion to private real estate. That number was $33 billion in 2022. In 2024, that number was $6 billion. That's an 82% decline from these large allocators. When that amount of equity leaves the market, one, it means there's incredibly less competition on the buy side that we have to face when we're bidding on deals. But two, it makes it a lot harder for a lot of people to capitalize their deals, both in development and on the acquisition side. We think there's a real opportunity to buy today because we're not facing as much competition. And let's go back and put it all together. If you think about buying today at a higher cap rate, because there's less competition, it's higher interest rates, so you have a higher cap rate going in, but you're capping an income that is depressed due to lower occupancy and lower economic occupancy, which means concessions or delinquent rent, things like that, you're actually paying a significantly lower price for that asset. And we think that the operational tailwinds in the next few years are going to be dramatic, and think there actually could be a real snapback, both in terms of occupancy and rent growth. So capping lower income at a higher cap rate today, we think is going to bode really, really well. This shows the same data, but one thing we wanted to point out, that the reduction is not a result of redemptions. That drop from $34 billion to $6 billion is not a factor of redemptions, even though there has been significant redemptions as investors within those large private REITs are allocating away. So I kind of just hit on some of the punchlines here, but they're really interesting stories to evaluate in multifamily right now. Historic supply deliveries creating softness in occupancy, reduced rental rates, and lower NOI. But we see a long-term supply and demand picture that we want to invest into. We think it's a really compelling time to be investing. You're doing it with less competition, and we think that the pricing we're going to pay today is going to bode really well in the future. Specifically, we want to invest in assets that are going to be well positioned to capture the attention of the large institution when that capital comes back. Maybe it doesn't go back to 34 billion, but even if it goes from 6 billion to 20 to 25 billion in the next few years, that capital is going to come back and they're going to be looking to invest. And we want to have assets to sell to them when things start to get really hot again. So we're continuing to look for those types of opportunities. And as Lindsay mentioned before, we think real estate's always investable because there's human error. People are making mistakes, and it's our job to go out there and find those mistakes and take advantage for the benefit of our investors.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.